Welcome back. Today we're going to be looking at something very important for Palantir investors, which has impacted the stock to date, has sent the stock lower, has a lot of people on the edge and more so on the other side of the fence when it comes to investing in Palantir, and that is the insider selling, dilution, and stock-based compensation. Today, courtesy of TJ Evans, great follow on Twitter, really great resource for the Palantir community, so please do follow him and his work. We have a full thread on Reddit with insider selling, dilution, and stock-based compensation. Just right up front here, he says the TLDR being insider selling exceeded expectations for Q1 2022, and dilution and stock-based compensation are in line to exceed expectations from the S1. S1, of course, being their initial document that they released as a statement to go public. This was back in the fall of 2020, and we can anticipate further normalizing over the rest of 2022 into 2023. This is, of course, in line with what Alex Karp was saying at the conference call. A lot of people being like, oh, can you even trust him? Well, that's up for interpretation, of course, but he's trying to guide towards truth. He's trying to guide towards certainty. So I think he is trustworthy in that regard. It's just a matter of how soon that's going to happen and to what degree. So we have evidence of that, which is great. He says he'll update this every quarter. Check back in his spreadsheet. Pinned tweet. The exceed expectations means a bullish slant. Insiders sold less physical shares than expected, and dilution was less than expected. Okay, so here we are on the PLTR Reddit. Great place for information again. So here is TJ Evans on Reddit with his official post. So here we have all of this is not what we'll be talking about today, but here we have all of the SPAC investments and other investments, private equity if you want to call it that. And here's all of their unrealized gains and losses. Okay, so this is very interesting. I should have been looking at this before. So it seems like some fairly big losses. It doesn't look like we have a total on that. Unless we scroll down, maybe it looks like Palantir's lost about $170 million when it comes to SPACs. So just interesting to know that full list right there. And here's if you wanted to dive into Foundry for Builders, cohort 1 or 2, Foundry for Crypto, which hasn't come out yet in terms of a real cohort. Of course, they've been developing the product. That'll be interesting to see. So here's what we'll be talking about today, which, as I already said, as you already know, the actual numbers when it comes to the insider ownership and dilution, stock-based compensation, and when it comes down to each of the key executives and other members of the board. May it be that. I'll be supplementing the video with screenshots so that you can best understand in a video format what is happening. I will be reading through TJ Evans' post and commenting when I find it necessary to do so. He says, Q4 of 2020 and all of 2021 yielded massive selling from venture capitalists, regular and past employees, and executives. Much of this was anticipated since liquidity was a big driver for direct listing. So, of course, that's why the direct listing happens. That's the mechanism for which a direct listing to occur. Employees and existing shareholders are selling onto the market rather than getting investment banks involved in all of that, in valuing the company and taking the stake from there. So this is the nature of a direct listing, but it doesn't mean that some investors weren't shocked by this, all of this selling that occurred. So we should continue to anticipate some insider selling for 2022 and beyond. The primary driver of the anticipated C-suite selling is vesting of RSUs, which are restricted stock units, on a quarterly basis, which began in August of 2021, and the most recent event occurred in February 20th of 2022. So we're going to check in and see how that's going so far. Starting with Alexander Moore. So Mr. Moore sits on the board of directors and is considered to be a founding member of the company. And since the lockup period expired, Moore has sold once a month like clockwork. Regardless of the share price, tranches have varied between 11,000 shares and 80,000 shares. Note that he did sell about 500,000 before lockup expired in a few batches. In total, he sold about 700,000 while still holding nearly 2 million shares. And prior to the direct listing, he actually had about 2/3 of a million more, 667,000 more shares. So that's the amount that he's dumped approximately. And he received actually 148,000 shares upon the direct listing. His monthly sales are trivial, but I expect them to continue. I brought Mr. Moore up specifically because I noticed some complaining about this on the subreddit. Of course, when you have constant and continued selling pressure, that's not a good thing. That's not helpful. Of course, the way a stock moves, it's not just if one person buys or one person sells, because there's always someone on the other end of the transaction. But the way it works is if you have these big chunks, these big blocks of stock getting sold that continues to hit down on the order book because it puts pressure on the stock. When there are buy orders set up at a market price or slightly below the market price, when all of these sales start to hit the order book, it continues to drop the price lower and lower. Now on to Shyam Sankar, who is the Executive Vice President and Chief Operating Officer. He's only filed one Form 4 this year, which is the Statement of Beneficial Ownership, just so you're aware what a Form 4 means. And it's related to the vesting of his 375,000 Class B shares, vesting from his 2020 plan, and other Class A RSUs vesting in 2010. So he's been at this a while, and he's now reaping the benefits of those shares. So those 375 Class B 1,000 shares and the 200,000 shares Class A are going to vest, resulting in the sale of 267,000 shares for tax withholding obligations. Obviously, you need to sell stock in order to be able to pay your taxes from your RSUs that are vesting. So this is standard procedure. It's worth knowing how many shares are here. So there is one note that Sankar did not convert his remaining Class B shares to Class A, which has been habitual for him in the past. Okay, that's very interesting. One vote per share, I should say, based on the Class A shares. And if we go to Class B shares, you'll get 10 votes per share for the Class B shares. So for him to not be converting his Class B shares into Class A shares, I'm not really sure what that means logistically. It probably doesn't make a big difference because he's got most of his shares likely in one of the higher voting brackets or whatever. So I'm not sure there's much to be gleaned from that, and I'm not even sure what even the takeaway really is. But let me know what you think in the comments. So Mr. Cohen is the president and secretary. He's only filed one Form 4 this year, which is related to the vesting of 675,000 Class B shares, again from the 2020 plan. And as usual, he converted 345,000 of those Class B shares to Class A, which is the majority of those, but not all. And he sold these for tax withholding obligations. Comes up again and again. We saw Elon Musk have to do that, and actually almost obligatorily choose to do that to essentially increase his tax bill, but that's beside the point. Cohen usually sells all acquired Class A shares and holds the trivial 592 shares for whatever reason, while still holding 11 million plus Class B shares and also his Class F shares. So it's worth bringing back around to this Class F share, which the Class F share means that the actual owners of the company, so the co-founders, get majority ownership. While it is technically not majority, they do literally have a controlling stake in the company. They own collectively 49.9999999%. He's got those shares as well, being a co-founder. Now on to David Glazer, who is the CFO, and his compensation plan is a bit more complex and comes from the 2010 plan, but the basic idea is that he receives multiple tranches of Class A RSUs. He sold 93,000 shares for tax withholdings, but also executed his 10B51. 10B-51 means it is a pre-planned sale, and it has to be registered ahead of time, sometimes months, sometimes weeks, I'm not sure exactly, but it means that pre-planned, you can cancel those ahead of time if you choose to, but they are pre-scheduled, and that was 107,000 shares, and he still holds over 2 million Class A shares, and as many options. Now on to Ryan Taylor, who is the Chief Legal and Business Affairs Officer. His compensation plan and stems from the 2010 plan as well, but the basic idea is that he receives multiple tranches of Class A RSUs. He sold about 82,000 for tax withholdings and executed the 10B51 pre-planned sales on the open market for 78,000 more shares. He holds 750,000 Class A shares, but also about 1 million Class B options. So it's worth noting that Glazer and Taylor did not receive any awards from the newest compensation plan, so perhaps it is in their best interest to diversify. And here, TJ Evans notes that this is not necessarily bearish the way it is currently playing out between those two. Now, on to Alex Karp, the CEO, as we all know him. He was responsible for the largest insider selling since the direct listing, which came from primarily these tax obligations associated with his 70 million plus expiring options. He has not filed a Form 4 this quarter, meaning that he has not sold yet, but he actually has 975 100,000 Class B RSUs vesting as part of his quarterly vesting schedule associated with the 2010 plan. So it's a bit surprising that this hasn't happened yet. Q1 is wrapping up very shortly in the next couple weeks, but we haven't seen a Form 4 yet. The RSUs vest on February 20th, 2022, and as of today, he has still not filed a Form 4, which is an indication he will not sell shares to cover his tax obligation, but instead is paying out of pocket, which makes sense since he sold about $100 million in excess for his tax obligations, according to TJ Evans last year. So this is good news. So might withdraw just a tiny bit of selling pressure if he's not selling to pay for taxes this time around this quarter. If he actually sold ahead of time, not necessarily meaning this has anything to do with the current stock price and Alex Karp thinking it could be that he doesn't want to sell more at this current price. That's definitely possible. But again, remember for them to be getting them, meaning these executives, getting these RSUs at so much lower of a price in 2010 and back in 2020, that the stock price really doesn't matter. Sure, it means a lot. My 2 cents is that it doesn't matter. If they're going to sell, they're going to sell no matter what. And now on to the dilution of the Class A and the Class B share count. So share dilution in 2021 only came about from the RSUs. And since the direct listing has been the only true expansion of the grand total of shares, which is the total shares outstanding plus the dilutive shares added on. So TJ mentions how a few warrants exercised by private equity holders actually happened, but there are no meaningful offerings from that, and some other notes as well. But skipping ahead here, the grand total count aggregates all of the share classes outstanding, all potentially dilutive RSUs with vesting periods between 4 and 10 years. So could be between 4 and 10. We saw with 2020, or actually 2010, we're still seeing those today. So it's worth noting that these are long-term plans, of course, to keep the executives and anyone else in the company and see the longer term vision, and of course drive returns for shareholders along the way. So for Q1 2021, he's actually 2022, not 2021, he's actually seeing slightly lower in the grand total from the S1, which is from Q4 2021, so actually just last quarter. So clearly the rate of dilution for the outstanding share count is decreasing. And TJ says, I maintain the forecast that quarterly dilution will normalize to a rate of 0.1% to 0.25%, so a 0.25%, within the next 12 to 24 months. I don't want to regurgitate a lot of stuff from the past posts, so you can definitely check out his other information. What he's seeing is completely in line with or positively exceeds expectations. Each quarter gives us more data to analyze, so this is, of course, subject to change. But as of now, I remain in agreement with Karp that when he said, and I've played this clip before, the dilution thing, that's a red herring. We're not issuing a lot of new shares. I think it's like in the $9 million range. Okay, so, Karp being hyperbolic sometimes, but it seems like he is telling the truth, not that he's untruthful. He tries to be as truthful as he can. He was talking about and being very aware with and forthcoming about risks on the conference call, this being one of them. I think that was a great thing for shareholders. And you would have known if you actually cared enough about Palantir to actually look into it. Again, a lot of people that degrade the company, or the stock rather, for being so dilutive and saying, oh, they issued 100% new shares just in 1 year. Well, not actually. I mean, I guess theoretically, but they back it in. They back it in all the way at the beginning of the S1 filing. Everyone knows about it. It's not like it just happened overnight. They backed it in. The dilution, it's not the time for this, but basically what Karp was saying is the original way they were managing the company was to issue equity to give everyone a stake, and a very healthy stake, a large stake, to get their commitment. This is not really how you want to manage the company of any company. Just from what I've heard and kind of what I would think about running a company, you try and keep as much ownership for yourself. But it seems like Karp and the other executives actually flipped that on its head and actually issued as much as they could to spread the wealth, if you will. So continuing on here, management warned that the about 180 million options will expire through December 2022 if not exercised prior to their respective expiration dates. And we expect many holders will elect to exercise, of course, because they have to, otherwise it becomes worthless prior to the expiration. Upon exercise, the holders will receive shares of our Class A or B common stock, which will subsequently be sold. So that's how it's been happening. They get the options, they convert the options into shares, but they have to sell some of those shares to pay the tax obligation from the earning of the RSUs, which is a taxable gain because it is an income, or whatever you want to call it, investment gain. So that was actually altered to delineate how many options are expiring from CARP. So as of the 10K, the sentiment is approximately 10.8 million options, down from 180 million options, will expire through December 2022, which TJ says he finds relevant since the exercising of these options demands tax withholdings, which demands conversion of B to A and subsequently selling of shares. Clearly, the headwind from these events is continuing to diminish. Okay. Great. So on to the stock-based compensation. Q4 2021 yielded the lowest stock-based compensation since the listing at $167 million, which is an average of still over $500 million, closer to 2/3 of $1 billion. And while management has not explicitly provided guidance for this in terms of dollars, CARP did once again mention on the call there will be a normalization that will get us into a range where you would see a software company within the next 18 months, latest 2 years. So this can be backed up by the reasons that the performance-based vesting condition for RSUs was triggered by the direct listing, and thus explains the massive Q3 2020 stock-based compensation expenses. Of course, one-time thing, no analysts are concerned with the Q3 2020 expenses. That's when they were able to recognize all the dilution going forward, stuff like that. Unlikely to repeat. And the 2010 plan is nearing a close in terms of RSUs and stock option vesting. This remains relevant since the company generally recognizes stock-based compensation on a straight line basis. The point is that some of these old warrants from the 2010 package are still to be recognized on the balance sheet, which ought to end soon on the basis that executives compensated under the 2010 plan have RSU or option vestings that terminate this year and in various quarters of 2023. So that needs to wrap up, is basically the sentiment there. The largest increase of stock-based compensation is due to the 2020 Executive Equity Incentive Plan, which has been terminated. So there are going to be no new awards which will be granted to the C-suite of executives, and the 165 million options and RSUs granted under this plan will vest over 5 and 10 year periods, and the stock-based compensation off of this is related to the fair market value of the stock in the time of granting, which was $7.60. So last bullet here. Company actions since direct listing do not imply major acceleration in dilution or stock-based compensation. The company granted 0 options in 2021 and basically no options in 2020, aside from the rather large 2020 executive compensation and incentive plan, while also granting 28 million RSUs at an average fair market value of $24.08, which is rather unfortunate because that cannot actually be exercised. Those are now worthless due to the company's stock price being lower than it was when that was recognized. So they had to cancel and reissue a huge amount of options, but it's not going to be very relevant, he says. You can look to anticipate a potential uptick in the number of RSUs granted this year due to the share price being lower. So that's very key. I was wondering what the change in the share price does. So an uptick in the number of RSUs granted this year. So my question is not just how many RSUs are going to be granted and not just the expenses recognized by the company, but more so how does this change the dynamic of the employees? So are the employees going to be more motivated to have more of these RSUs to drive the stock price? I guess that doesn't really matter because motivation can be really anywhere. And the hiring of many more employees, which 3,300 last report, and it's up from 2,900 on Q4 earnings. A reasonably high estimate, I think, would be 50 million RSUs over the course of this entire year, which would vest over a 4-year period. After direct listing, their service period guidance for RSUs has been 5 to 4 years. Okay, so that's everything right there. I will leave the link to his spreadsheet in the description. Let's see some concluding statements here. It remains critical to be vigilant to decide for yourself if you think the SBC will be outpaced by revenue growth in the coming years. That would be very bearish. And that would be also one of the worst management decisions that could ever happen, I think. This is the bear case. TJ says that he's remained convicted that revenue growth will greatly outperform stock-based compensation and dilution, and he's of the opinion that insider sales are a diminishing headwind and that management is moving in the right direction. So far, insider sales have exceeded his expectation for this year, meaning they sold less than he expected. Moreover, management has delivered on what they promised, but perhaps has not met the expectations of all investors, which is not unreasonable. He believes that execution risk remains to be more concerning for Palantir in comparison to the topics addressed in this post. But he says he thinks the more clear the picture you have as an investor, the better decisions you can make, which is why he continues to cover this aspect and shares his thoughts. Again, please follow TJ. There's no TLDR on this one, so I hope this video was helpful. Again, check out the information he's got here. He's been doing it for many months, many quarters, and this is exactly the type of analysis we need on Palantir as a company, especially when it comes to these different topics. And I hope this was helpful. Leave a like if it was. Go follow TJ, and can't wait to see what happens next from Palantir. Until next time.